So the main concept behind this strategy is to time the first pullback and aim to enter at around the end of the pullback. The key reason for this comes down to one crucial factor: risk to reward ratio. Let's break it down with an example. Imagine spotting a setup where the price was initially in a downtrend. Then, a strong buying pressure pushes it upwards. As a trend trader, you might see that the trend begins to shift and think about entering buy. But buying immediately at the highs of the trend isn't the best move. Why? Because there's a chance that the price could pull back. Or worse, the uptrend could fail entirely. If you enter at the highs with a tight stop loss, the pullback alone could stop you out. And if you set a wider stop loss to account for the pullback, you'll end up with a much bigger loss if the trend fails altogether. This is exactly why waiting and entering at the first pullback is almost always the better play. At a pullback, you're getting in the trade at a more favorable price, which means your stop loss can be tighter. If the price keeps dropping after the pullback, that's a signal that the uptrend is invalid anyways, so having a tight stop loss keeps your losses small. But if the trend holds and price pushes higher, you're set to make bigger profits since you've entered in at a lower price. It's a win-win condition. You'll get smaller losses on failed trades and much higher gains on successful ones.